Well, this is a video that's been requested numerous times, is what am I doing with my Beyond Meat trade. So I'm going to explain to you how I've modified that trade and what I'm doing with it. I still have my thesis in place that Beyond Meat is a short. I am, as each day goes by and I uncover more and more information about this, I become more and more convinced that this is a short. I believe that this is tantamount or very close to what would be called a pump and dump. And it's just my opinion, but I believe this does look very much like a pump and dump. And I'm going to make my case using some of the concepts from the CFAI readings. Level 3, we do a lot in behavioral finance. There are 3 readings in behavioral finance. And there we learn about the framing effect. And the framing effect is you can get a different reaction out of people depending on how you frame a situation. So a good example is, and because we're doing Beyond Meat, let's do it this way. You can have ground beef on sale, or not on sale, but on the shelf. 2 packages, one that's 80% fat-free and one that says 20% fat. And you could price the fat-free one $1 more per pound. So 80% fat-free is $7.99 a pound, and 20% fat is $6.99 a pound. And people will select the 80% fat-free because it's framed that way. Meanwhile, 80% fat-free means 20% fat. So just by framing something differently, you can get a different reaction. The case I'm going to lay out is that Beyond Meat is excellent. They are experts at framing. And I'm going to show you how they frame almost everything, including their financial statements. I've uncovered a few little things in there that you know, you sort of scratch your head and say, other than framing, why would you make that choice? So we're going to look at 2 choices that they've made in their financial statements that when I present them to you, I want you to ask, you know, why would you do that? Especially the second one doesn't make any sense at all. We're going to look at the stock price and look at a reaction that happened this week on something that shouldn't have happened. The reaction should not have happened because it was old news, but it was just for a lot of shareholders in this company. It's new news because the shareholders in this company are not shareholders that do deep dives. They're headline surfers. They're momentum traders, and momentum traders don't really think a lot about what they're doing. We're going to look at so the presentation choices. We'll look at framing effects, and then we're going to just ask some general questions about this whole fake meat or plant-based meat industry. The CEO of Impossible Foods this past week said that that their industry, plant-based meat, is going to replace the meat industry in 15 years. All CEOs are bullish on their product, but I can't think of a more ridiculous statement than that. I'm going to make that point. You may think, for the bulls that are listening out there, before you hit pause and pour your hate and anger into the keyboard to leave nasty comments under the video, open your mind for a second and just hear the bear case and ask yourself, does it sound realistic? And then if you want to pour your hate and vitriol into your keyboard, go to Fox News. Lots of people like that out there. If you leave nasty comments under this video, I will just block you. Now, the interesting thing about blocking you is when you type in your comments, you see them. So you think that they're still out there, but no one else can see them. Only you. Only in your browser can you see them. So you can scream into your keyboard all day long and you're just wasting your time. Anyways, let's look at what happened this week. Here is the whole week up on Beyond Meat. Monday, Tuesday, Wednesday, pretty much down days for the first 3 days, and Thursday was a big, you could see this big volume spike. And this was a news report released by CBC saying that McDonald's has ended its trial with Beyond Meat and has no plans to introduce anything. Well, we knew this information. This information's 60 days old. We already knew this information. This information was already out there. McDonald's had ended its trial. And I'm going to show you the transcript from the earnings call that happened a while back, where the question was blatantly asked. And I think it was asked the right way. And the CEO just brushed it off, which is what they do. They will never directly confront negative news, but they are fantastic at producing headlines that completely blow out of proportion what they're doing. I'm going to show you one headline that they produce that when you dive into the details, you go, well, hang on a second here. This is nowhere near what you're saying it is. And we'll look at their sales. And, you know, they're great at showing year-over-year sales. But when you look quarter-over-quarter, it's not there. Sales are actually declining, not increasing. It's just an illusion. So this was, CBC had put a story out, McDonald's Canada ending its partnership with Beyond Meat, and it has no plans to introduce anything at this point in time. But this was known back in April, I believe it was. And then it was, see this big green spike up here that I'm showing you at the bottom of the screen? That was a story that came out at 2 saying, hang on a second, that story this morning about McDonald's, that's just a repeat of something 2 months ago. And then, you know, that big massive sell, oh, it's a repeat. Okay, well then that's fine. How can this be the first time that you're hearing about this? If this much money, and by the way, that drop in value on that news represented about $900 million of market cap on this company. If you can throw away $900 million of market cap on a story you should have already known, that tells you a lot about the type of investors in this stock. It is a group of sheep who are buying the sizzle, but there is no burger there. Or as they say, there is no steak there. And that's a better thing to say. There is no steak there, and I'm going to prove there is no steak there. If you want steak, you're in the wrong place. And then, so it rebounded. Oh, that's old news. Doesn't change anything. It's still a fact. If you responded to that fact at 9:30 in the morning, and at 2 o'clock it was still a fact, just it was a 60-day-old fact. Oh, it's 60 days old. Okay, well, up we go. You kind of wonder about what's going on there. And then, of course, well, you know, Friday, I can't blame anything on Friday. Friday was a weekday across the board, but the trend all week is in the right direction, is down. I'm not saying momentum is over. I still think this stock has some near-term upside because Beyond Meat is excellent at producing headlines for the momentum crowd. And into that surging upswing, as the price goes up, insiders and directors sell into it. Pump and dump, pump and dump. Now, I'm not saying that is their malicious intent in their mind. To me, this is what it looks like. That if I were doing this, I think somebody would knock on the door and say, you know, that's illegal, right? You can't do this. You can't pump up a stock and then dump stock onto people buying it. In this case here, they're producing headlines. They're not really lying at all. They're just framing it in such a way that it appeals to a crowd who will not dig deep on this stock. Let's look at this McDonald's thing, and let's look at the transcript of the earnings call, and you'll see that this was known information. All right, this was the headline that hit that morning, Thursday morning. McDonald's deal with Beyond Meat expires. And it was a story that CBC News had put out, the PLT, the plant lettuce and tomato. These two paragraphs here are really telling, and this will lead right into the transcript. The vegetarian burger offering quietly disappeared from the menus of test locations at the end of its trials. Responding to inquiries, the company tweeted, "Our plant-based burger was being tested in several markets until April 6th. We have no current plans to bring it back to our menu at this time." That's McDonald's saying that we have no plans to bring it back. And this is a great line here. During Beyond Meat's May 5th earnings call, so it was known way back in May. An analyst brought up the McDonald's trial and the absence of an immediate continuation or partnership. CEO Ethan Brown responded, "I can assure you there's no issue with McDonald's, let me put it that way." And that's exactly what he did. He dismissed it, buried it very quickly, didn't want to talk about it, and just moved beyond that point. So let's have a look at the transcript of the actual exchange between the analyst and the CEO. And the analyst, when he asks a question, it is an obvious, straightforward question, I think. that if something is good, why would it end? It would continue, wouldn't it? And we'll have a look at that. All right, so this is a transcript of the conference call. The operator, our next question comes from Ken Goldman with JP Morgan. Hey, good afternoon, everybody. Ethan, that's the CEO. You mentioned that QSRs are quick service restaurants. They don't want to be called fast food anymore. They just want to be called quick service. So quick service restaurants. You mentioned that QSRs are not making any major decision right now as far as your products. I did want to make sure, though, on slide 11, just looking at the text there, it says McDonald's Canada that the test happened between January and April 2020. And it's the only customer on that slide with an end date. Am I reading too much into that line? Or did the test end last month? Just wanted to see if I'm missing something there. Ethan said, yes, no, not at all. I mean, the test was for that period, and it did conclude with no negative reason at all. I mean, we feel very good about our relationship with McDonald's and what's going to be happening both there and potentially elsewhere. So by the nature of it being a test, it had a beginning and an end. No real answer, just, yeah, okay, it had a beginning and an end, you're right. That's really not the question that's being asked, right? So can I follow up on that? Because typically, if a test did well, the retailer wouldn't end it. They would expand it. So can you help us understand a little bit why it stopped rather than going the other direction? And his answer, I mean, I think it would require me to sort of open up the broader discussion. I can assure you, there's no issue with McDonald's, let me put it that way. This is a way that it's been planned and the way it's being executed, and there's been no change at all. I can't promise you that we will see a massive expansion tomorrow, but there's been no change in information since we began this test and got good results in the beginning and got good results at the end. So I go back to his question. If it was successful, it wouldn't have ended. I can assure you, if McDonald's, wherever they were testing it, if this thing was really selling, the last thing they would do would be to end it. They would either continue it on or expand it into other markets to see how it tested in other markets, but they just ended it. So this information was already out there that McDonald's had ended their test, and that was it. They removed the plant-based menu items from their menus, and that was it. And the CEO's rather cagey here, not giving an answer. When you get cagey answers, it's because there's something missing there. The CEO does not want to talk about this at all. And just says, I can assure you, everything is fine. Nothing to see here. Let's move on. All right, so let's look at another test that Beyond Meat had done. And I want you to pay attention to the timeline in this particular test. Okay, this is from Tim Hortons. Tim Hortons removes Beyond Meat offerings from remaining locations. And this was a test they did with Tim Hortons. And let's look at the timeline here. If we can find the timeline of how this happened here. Where are we? The company first piloted the plant-based breakfast sandwich in May. This is May 2019. I want you to keep the timeline in your head here for a moment. We're in May 2019. So it piloted it in May before rolling out 3 plant-based sandwiches nationally in June. So it took them 1 month. They saw some promise there. They rolled out nationally across all of Canada in June. A month later, it added 2 Beyond Meat burgers to its menus nationwide. So this is looking good. We're in July. We have a national rollout of the breakfast sandwich, and we added 2 burgers in July. In September, not 60 days later, RBI announced it would continue to sell the alternative protein breakfast sandwiches only in Ontario and BC and scrap the burgers altogether. The burgers lasted 60 days. The national rollout got scaled down to 2 provinces. And in January, Tim Hortons has stopped selling Beyond Meat products in Ontario and BC, the last 2 provinces serving them after the company scaled back the plant-based offerings. A spokeswoman for the for the coffee chain's parent company says there was not enough demand to keep selling Beyond Meat breakfast sandwich in the 2 provinces. So why did they roll it out? I mean, they tested it in June. They said, hey, they tested it in May. They said, let's roll it out in June. The case that I would make is that sales of Beyond Meat are front-end loaded. They're a curiosity. They're a novelty. I've heard about this. Here it is on the menu. Hey, you know what? I'll give that a try. And so everyone's going to give it a try, or everyone who's interested or curious will give it one of those curiosity tries. Let's give it a shot. Let's give it a try. But no repeat sales. Front-end loaded sales and no repeat sales. And we're going to see this if we go back to the earnings transcript. There was a question asked about what repeat sales were. Actually, I won't show you it. I won't jump the screens. It's 46%. Which means that whatever you experience in your trial, you can expect only 46% of that going forward. So if you take your trial as being indicative of the demand you will have, you will be disappointed when you find out the repeat sales are lower. And that's repeat sales based on what the company is saying. We don't really know what repeat sales are. I believe them to be far, far lower than 46%. I think the repeat sales are somewhere below 20%, maybe even as low as 10%. And I'm going to keep making the case. I've got a lot of information to roll out here in making the bear case. In the end, I will make the bull case, though. I will do that. So several weeks ago, I think maybe even about a month ago, Beyond Meat really ran up in price into the 160s very, very quickly, on this announcement that Beyond Meat is partnering with Yum Brands China. That was the headline, partnering with Yum Brands China. Now I've just shown you a Tim Hortons test that failed. We've just seen that a McDonald's test failed, and we saw the exchange on the conference call. And this announcement that they partnered with Yum Brands happened after that. So we have two indications where tests happened and nothing happened out of it. And here we are announcing Beyond Meat expands overseas with Yum China deal. All the headlines are really, really expansive like that. I think the Beyond Meat press release referred to it as a partnership with Yum Brands China. Let me read to you what this partnership is if you dive into the story, not the headline. Now, the headline is meant for their shareholders because their shareholders are momentum traders who will only read headlines and look for confirming news, and they will just buy indiscriminately based on the headline without diving too deeply. I mean, let's face it, if the shareholders in the company can erase $900 million of value on a headline that's 60 days old just because they saw it again, that doesn't tell you that you have a lot of deep thinkers there. Anyways, here's the partnership. You tell me if this sounds like a partnership to you. Yum Brands has 8,500 stores in China. Taco Bell, Pizza Hut, KFC, 8,500 stores. This Beyond Meat will be in 3 stores. Taco Bell, 3 stores for only 8 days. It will be in Pizza Hut, 6 stores. Only 6 stores for 4 days. And it will be in KFC. It'll be in 5 stores only for 3 days. So Taco Bell, only 3 locations and only for 8 days. Pizza Hut, only 6 locations and only for 4 days. And KFC, only 5 locations and only for 3 days. So that is a total of 14 stores that it'll be in out of 8,500. Does that sound like it deserves the word partnership, or does it sound like it deserves the word test or small market test? They've ran all the way to the word partnership. Now, it's not untrue. It is a partnership in the weakest sense of the word partnership. But the word partnership was meant for public consumption, was meant for their shareholders to read. Partnership with Yum Brands China by, because it's got all the words in there, right? You know, Yum Brands, China, partnership. Meanwhile, you look at it, you go, well, I don't know that I would call that a partnership as much as a test. And haven't we already seen this story before? Twice? Hasn't it been tried and done and died twice? Now, I do expect that the results from this will probably be good because sales are front-end loaded. They'll show up there and there'll be curiosity. Oh, let's give that a try. I've heard stuff about it. Let's give it a try, that curiosity purchase. But the repeat sales aren't really there. So I do expect another announcement out of Yum Brands. Either there'll be no announcement and Beyond Meat will say nothing about it, or they'll expand the test and Yum Brands will print press releases. We'll push that like you've never seen before because they know that the momentum crowd will just read the headline and not really think too deeply about it. And I'm going to show you some numbers from their statements now of how they frame things. We're going to look at their cost of goods sold. We're going to look at how they present the numbers on their financial statements. And it's super interesting. I had to think about it for a while of why would you make that decision, until it occurred to me that it's in line with the way they make all decisions. It's how they frame things for their shareholders. Let's just go to that now. All right, what I have on the screen right now is the condensed statement of operations, 3 months ended September 2019 and the 9 months ended September 2019. Notice that it's presented in thousands. You just drop off the zeros for this, only because the zeros there's no informational value in there. So this is really 91,961,000. Each number is presented in thousands. There's a lot of focus on the gross profit and the gross margins. Net revenues, notice they use cost of goods sold. I'm going to explain what that means in a minute, and then they get to gross profit. There are two ways to present your gross profit. You can take your net revenues minus cost of goods sold, or you can take your net revenues minus cost of sales. Beyond Meat decides to use cost of goods sold. Which means you need to correct it for cost of sales. Once we correct it for cost of sales, we see that their gross margins are not as good as what we think they are. What's the difference? Let's say that you are a retailer and I want to sell you something, and you say that you're willing to pay $10 per unit dead cost. Dead cost means it must be $10 per unit on your floor. That means whatever I charge you, and whatever shipping and handling and insurance cost, it must end up to be $10 per unit on your floor. And I agree to sell it to you for $10 a unit on your floor. So I record revenue of $10. I take the product, and then of course I've got to pay the shipping and insurance and handling to you to get the $10 of revenue. Included in the revenue is my shipping cost to you. I'm shipping it to you, so it's in the revenue. Because if I didn't pay for shipping, you would not pay me $10 per unit. You might be paying me $9.75 a unit, arguing that the other 25 cents a unit is what you need to pay for to end up with $10 on your floor. But I, as the seller, I'm going to guarantee you the $10 price on your floor. I'll pick up all costs to get it there. Well, realistically, I should be recording cost of sales, because my revenue is only $10 per unit because I'm agreeing to ship it to you. If I did not agree to ship it to you, I would only have $9.75 per unit. My revenue would be lower. Beyond Meat makes the decision to use cost of goods sold. In other words, in that number is just the cost of the good that is sold, not the cost of shipping it. Now I'm going to show you. You got to dive into the notes to get it. So anybody not looking deep enough would say, well, you made 32 million on 91 million, and would calculate a gross margin based on that. Come over here. Shipping and handling costs. Outbound shipping and handling costs included in SG&A. They're not in cost of goods sold, they're in SG&A. So for the 9 months ended, what were they? Here it is right here, 7.4 million. It says here, expressed in 3 months ended September 29th, were 3.4, 2.1. This is year over year. So for the year just ended for 2019 was 7.4 million. So let's go back here. Cost of goods sold should be cost of sales, because net revenues reflects the fact that the buyer is paying based on it being delivered to them. That price is an all-in price, which means the cost of sales must be an all-in price as well, but it's not. Now, technically, that's not wrong to do. It's not wrong to break it out as long as you disclose that you're breaking it out, but it's part of the framing story that this company engages in. How to frame everything so that it looks the best. Now, if you're an analyst and you read it and you did your work, you'd say, okay, well, that's in SG&A. I'll back it out and I'll put it in cost of sales and calculate my margin. But that's not the type of shareholder Beyond Meat has. The type of shareholder they have will just look at the big numbers and say, oh, there we are. It's just a presentation choice. It's a framing choice. If you're an analyst on this one, you should be looking and saying, listen, you would not be recording 91 million in revenue if the recipient had to pay for the shipping cost because they would have negotiated a lower selling price. You're only getting this selling price because you are shipping it to the final consumer, which means it should be shown in cost of sales, not cost of goods sold. So they make that choice. That's one choice they make. I'm going to show you another choice they make that they just made, and I want you, if you can figure out why anybody would have made this choice, please tell me. The only reason that I can come up with is it's consistent with framing. It's to make the numbers look bigger. Notice that this is a condensed statement presented in thousands. This is the third quarter. Let's back out of here and go back to the list here. Let's look at the 10K. This is for December. And we'll look at the 10K here, and we'll go to financial statements and look at statement of operations. Notice it's presented in thousands. So this is 297 million. This is for the full December 31st, 297 million presented in thousands. In fact, all their statements are presented in thousands up to that point. Watch what happens when we go into the first quarter of this year. And let's look at the financial statement, and let's look at the statement of operations. Look how big that number is. Notice up here, it's not presented in thousands anymore. It's only presented in dollars. Why would you make that choice? So I think there must be information that is useful in those zeros. The company must have done it because you'd make a presentation choice based on the value of the information you're providing. So let's have a look. They're all zeros, all the way down. There's no new information in those zeros. So why do it? There's no extra information in the zeros. Well, look how big that number is now. Instead of just cutting off these three, imagine if these three zeros didn't exist right here. You'd have 97074. Well, that doesn't look as impressive as adding all those zeros. Now it looks like a really big number, doesn't it? It's the same number. The company can make that choice. It's just a curious question of why would you make that choice, though, unless it was for just framing and presentation. Or perhaps you think, you know what? Our users are already used to seeing the statements in thousands. Let's quietly pull the thousands away and add zeros. Maybe they'll read it as 97 billion. Because listen, if they're willing to wipe off $900 million of value on a company, on a headline that they should have been aware of from 60 days ago, from the conference call, they should have been aware of it. If they're willing to wipe out $900 billion, $900 million of value, you can put anything over on these shareholders. I don't understand why you would move to presenting your statements in dollars instead of thousands when these zeros add no informational value whatsoever. Now, on its own, it's not nefarious. You look at this and you say, well, I mean, it doesn't seem like a big deal, but in context of everything else that you do, I can only conclude that this is done purely for the effect that it has on the reader, purely for presentation purposes, purely for obfuscation, to try to fool the reader into thinking the numbers are actually bigger than what they are by making them look bigger because there's no value in the zeros. I don't know. Maybe somebody has an opinion of why they're suddenly presenting in zeros after presenting in thousands. Please let me know. Anyways, let's look at something else. See this thing up here that says 10Q? If you click on that, you will get their full 10Q with the management, with the MD&A. The interactive data is just the data itself. Let's look at something in the MD&A. All right, so if you click on that, you'll get something that looks like this. Just scroll down to the table of contents and look for the management discussion analysis. Here it is right here. If you click on this, it's worth reading. In any company that you're looking at, go to the MD&A. You're going to find some really good information down there. If we click down, they have a discussion of their net revenues. They have a discussion of their gross profit. And in the gross profit, they don't mention anything in here distinguishing cost of goods sold versus cost of sales. Again, you have to do the legwork yourself. It's all about framing. If we continue down, seasonality, they talk about seasonality. What are we looking for here? We're looking for, yeah, in gross margins, I think it is, or where is it? Oh, here it is, right here, after, just in revenues. They talk about the revenues from different channels, from retail, from restaurant and food service channel, and the retail channel. And they give you year-over-year comparisons, because the year-over-year comparisons are really good. Quarter-over-quarter, not so good, but year-over-year, really, really good. So let's talk about year-over-year, but let's not talk about quarter-over-quarter. And let's not talk about our repeat sales from existing customers. Almost every retail store, when they report earnings, will give you same-store sales. And this is a measure of their growth from stores that have been open at least a year. Because you can always grow by getting new customers and opening up new stores. You can always grow that way. But what you want to see for sustainability long-term is, well, of the customers you already got, what's the growth in the customers you already have? And they already say that their repeat sales are actually less than their original sales. So we know that their growth per customer year over year is negative. So when they get a customer, they front-end load those sales, and then the sales growth from that customer is negative quarter over quarter. What keeps their sales growing is the acquisition of new customers all the time. That's eventually going to run out, because this is a very crowded space very, very quickly. You're going to run out of new customers, which means you're going to have to get growth out of existing customers. And if those sales are negative, well, then off we go. Anyways, they don't break it down quarter over quarter. You have to do all of the homework yourself. So let me give you some numbers. In quarter four, this is, I think we're looking at Q3 right here. But in quarter four, they had sales of $98.5 million. The retail channel was $40.7 million of that in the retail channel. In the third quarter, the retail channel was $50.5 million. So that is a drop of 20%. From the third quarter to the fourth quarter, you have a drop of 20% in sales quarter over quarter in the retail channel. But they don't present the quarter over quarter, they present the year over year, and the year over year looks fantastic. Again, they're framing it in a particular way. They're choosing what metric to show you. When we look at companies that report same-store sales, that's called a non-GAAP measure. There's nothing in GAAP that says that has to be presented. It's a non-GAAP measure, but it's a useful measure. So growth from same customers year over year is also a useful measure. You got to look for the silence. Where is the company being silent? And where it's being silent is because there's nothing good to say. It doesn't frame their business in a good light. It actually is negative. If we say, well, we have negative growth, quarter over quarter, and same customer year over year, we have negative growth as well. We're really growing by the acquisition of new customers and aggressive discounting. Wow. That doesn't sound good, does it? Now, in all fairness, before the hate starts pouring into the keyboards across the country there, in all fairness, they do talk about seasonality here. And they do say that certain of our products are seasonal during the summer grilling season. As our business continues to grow, we expect to see additional seasonality effects, with revenue growth tending to be greater in the second and third quarters of the year. And I'm going to explain why their sales are seasonal. And you may think, well, it makes sense. I mean, that their sales would be seasonal. But it is that very thing, the seasonality of their sales, that highlights the major weakness in this particular company, and the reason why this will never, ever, ever, ever replace meat. The CEO of Impossible, I think I said this earlier, said in 15 years we're going to replace the meat industry. No, you're not. So, long journey so far, right? Let's just look at this claim that products like Beyond Meat, Impossible Foods, and all these plant-based meats can replace the meat industry in 15 years. Well, you have to accept that the consumer is willing to take two things. Number one is they're willing to trade off a product with one ingredient for a highly processed product. On the screen, you can see the ingredients of a Beyond Meat burger. If you buy a New York strip and you flip it over, they don't have the term ingredients, but if you could look at ingredients, it would say meat, period, one ingredient. It's not processed. It's meat. This water, pea protein, expeller pressed canola oil, refined coconut oil, rice protein, natural flavors. Well, I mean, that's good, right? Cocoa butter, mung bean protein, methyl cellulose, potato starch, apple extract, pomegranate extract, salt, potassium chloride, vinegar, lemon juice concentrate, sunflower lecithin. I don't know what that is. Beet juice extract, for color only. This is a highly processed piece of food. Now you may think, but it's healthier. It doesn't have any soy and it doesn't have any gluten. Neither does meat. I mean, you wouldn't pick up a 3-pack of New York strips and expect to see in the top corner, no soy, no gluten. You would say, well, yeah. So Beyond Meat's claim is, well, you can have this highly processed patty instead of a New York strip because there's no soy and no gluten. Well, neither does New York strip. And the claim, oh, but this is healthier. Is it? Let's have a look and see if it's healthier. All right, this is a story that was in the National Post, and it's citing a food scientist at the University of Guelph, Michael Rogers. This is a nice quote here. These consumers are blindly purchasing foods that they think are healthy because they associate with a plant. Let's just have a look. The 113-gram Beyond Meat patty. And by the way, this is when you buy them in a 2-pack at Walmart. I think the price is, let me look up the price here for you. The price is $7.97 for 2 113-gram patties. These are like 4-ounce patties. So 2 of them make half a pound, $7.97. If you bought ground beef, it would be $2.59 at Walmart. I priced it out at Walmart. This is not the value pack. This is just their normal product. So as long as you're willing to pay triple for a highly processed piece of meat, yeah, you can replace ground beef. But let's look at how healthy this is. 113-gram Beyond Meat patty has 250 calories, 18 grams of fat, 390 milligrams of sodium. That's the big thing, the salt, right? And 20 grams of protein. You may think, oh, 20 grams of protein, only 18 grams of fat. Health Canada says 113 grams, and this is Health Canada. They have no dog in the fight. They're independent here. 113 grams of lean ground beef contain 292 calories. So you're getting more calories, yeah. 16.5 grams of fat versus 18. There's actually less fat in lean ground beef than there is in Beyond Meat, a Beyond Meat patty, 16.5. Look at this, 390 milligrams of sodium, 105 milligrams of sodium. So it's got a lower salt content. You may think, yeah, but the protein, right? 33 grams of protein versus 20. So the big thing about Beyond Meat is, you know, the low-fat, high-protein content, but the same amount of ground beef actually has less fat, less salt, and more protein. You're just getting more calories, 292 versus 250. And this is a good thing. It worries the proliferation of Beyond Meat is only adding to a growing food crisis, where in Canada 50% of people's calories come from ultra-processed foods. This is an ultra-processed food, highly processed. Look at all the ingredients. It has a higher fat content. It has a higher sodium content. It has a lower protein content. Really? Something that's less? Something that has more fat, more sodium, less protein is suddenly going to replace meat? Something that's highly processed is going to replace something that is not? I don't know. Now let's take that a little bit further and let's think about the meat department. And I want you to see if you think that you're willing to substitute certain things. Okay, so I want you to think about the meat department. And let's talk about this claim that Beyond Meat or that plant-based meats are going to replace the meat department. This is available in a highly processed patty. You can have a pork patty, I think you can have a turkey patty, or you can have a beef patty. So at Christmas, will you stop buying the turkey itself? No more decision between do you want white meat or dark meat. Everyone gets a turkey patty. You want a New York strip on a Saturday night after the ball game with a nice red beer, a baked potato, sour cream and bacon? Nope, no New York strip. But you can have a beef patty. What about lamb chops with mint? Nope. They don't even have a lamb patty. But you can have a pork patty or a beef patty. You want a duck or a goose? Nope. But you can have a turkey patty. Do you want pork chops? Nope. But you can have a pork patty. As long as you're willing to substitute all the meat product that you buy. No more pork chops, no more New York strip, no more T-bones, no more turkeys, no more lamb shanks. Take all the meat. You want prime rib? Forget it. You want roast beef? Forget it. Take all the meat in the meat department. And you can replace all of that with highly processed patties that have no soy and have no gluten, but neither did the meat. And have a higher salt content and a lower protein content than the meat. Oh, and by the way, it's triple the price. It's double to triple the price. Really? Almost everywhere that this product shows up, sales are big on the front end and die down. They don't have repeat sales customer year over year per customer. And you need a certain amount of shelf turnover to keep that on the shelves. With the likes of Nestle and Tyson jumping in. And by the way, there's about 40 or 50 companies with this type of product. And all it is a patty. Like you can have the meat as long as you want it in patty form, but you can't have a New York strip. You can't have roast beef. You can't have a prime rib. You can't have a honey glazed ham. You can't have a turkey, chicken, duck. You can't have lamb shank. Think of all the meat that you buy that you can have if you're willing to take it in a highly processed patty form. Does this sound like something that's going to replace meat long term? No. This is a novelty, and I've been saying it all along. This is a novelty. Sales are front-end loaded. There's nothing there. This company is fantastic at selling the sizzle, but there is no steak. Literally, there's no steak. You want a steak? You can't have one. You can have a highly processed beef patty, though. Highly processed beef patty with baked potato and sour cream, and, well, you don't want bacon anymore, right? You want a highly processed bacon bits on there, which I think you can already buy that are not really bacon. In the end, my position is still a short, and I've added to it. What I did was on the run-up on this announcement, this China deal, it ran up into the 160s, and that's where the stock broke one of my cardinal rules: is never, ever, ever short a stock under momentum. And even though I wasn't short the stock, my position was a short position. Never short a stock under momentum, because momentum, the fundamentals don't matter. They simply don't matter. Oh, they'll come back into play, but they don't matter, and the momentum crowd reads headlines. That's it. They don't do deep dives. They read headlines. When momentum breaks, it breaks, and it's over. But I think this company probably has some headlines left in it before it just becomes overwhelmingly obvious that, there's really nothing there. But I think it has a few more headlines in there, so I think it'll make some runs up. So I had the 120 puts, and I sold 2 165 calls against it to make it a free position. A while back, it dipped below $120. I think it got down to $116. My position was $1,800 in the money, because I only did 3, just really light. It was $1,800 in the money, and I noticed that I could roll them forward into November for another $3 debit. So that's what I did. I closed out my position, and I rolled them forward into November. I was able to get the same 120 puts, but instead of financing them with the 165s, I was able to go up to the 170s and still get $3 in for that. So I rolled the 3 forward over for November. I'm up $2,700 at that point. On the run-up, closing the calls put me in a loss. And then it pulled back. It ran up again. I went to November and I sold the $230 calls against it. So I'm back in my position, except instead of 170s, I now have 230s. Did take a little bit of a hit, which lowers my break even. But I did do a couple of day trades on the calls. When I saw that it was strong for the day, I would buy a call, a short dated call, and watch it run up. And slowly work off my loss. My break even, I think, is around 103 right now on the downside. So it's got to get to the 120s, and it's got to get to about 103. What I did was, in this past week, when I saw that reaction to the McDonald's thing, I thought, how can you not know? How can you react this badly on stuff you should know? I mean, as shareholders, you should know this. And with all of the insider selling and all of the framing effect that this company goes through, and how it won't talk about anything bad or present anything, any useful information that could be slightly negative, it's just not even presented. There's silence. I went and bought a bunch of November $145 calls, a lot. So I made a big bet on, not calls, sorry, puts. I bought 145 puts. So what's going to happen is I'm going to step in to a combo on this one. I just bought the puts. If the stock price continues to fall, great, beautiful. If it runs up, which I think it will, I think that this company's not done with its headlines yet. It's got earnings coming up. It's going to frame those earnings unless it simply just can't without lying. So far, this company hasn't lied about anything. It's either remained silent or framed. But it hasn't really crossed any lines that you would say, that's slightly fraudulent. It hasn't done any of that. I want to be clear. The company hasn't done anything wrong. It has just made decisions on framing. It's silent about everything else. When I said earlier, I believe this to be a pump and dump, it's that framing that motivates that momentum crowd to buy, and the insider sales, those are undeniable. That's just a fact. The insiders are selling into that wave of buying. So the decisions to frame, the decisions to sell, to me, it looks like a pump and dump. To me, if they really believed that in 15 years, like the CEO of Impossible Foods said, that they could replace the meat industry, you're talking about billions upon billions. I wouldn't sell. If I really believed that that was going to happen, I would not be selling. But they're selling. They're not buying. They're sellers. Think about that. They're silent about the negative stuff. They overhype the positive stuff, and they sell into strength. Come on, man. And again, if you're bullish on the stock, just walk through the meat aisle and ask yourself what could possibly be. Are you willing to get rid of all of that and replace it with highly processed patties? You can have anything you want as long as it's a patty. No more New York strip patty. You can have a beef patty. You want some nice pork chops, crispy patty. You can have a pork patty, but you can't have that. So that's what I've done. I'm still short on this stock. If there's a run up in price, I'm going to sell more of the $230 calls to offset the price of the puts that I bought. Now, if I would have done the puts and the calls at the same time, I would have had to go up in a certain price and get the calls. But if the stock price is moving up, my puts are going to drop in value, but these call premiums are going to increase, which allows me to go even higher. Why 230 for November? Because that's the extent of their options. There are no options with strike prices above 230. So I will gladly sell the 230s on this one. I remain short on this one. The only bull case is the shareholder, is the current group of shareholders. They are a momentum crowd. They will not think too deeply about what they do. That's the whole idea behind momentum, is you just find momentum. You don't ask a lot of questions. You just buy high, sell even higher. And as long as the company can continue to satisfy them, and this company is fantastic at framing and positioning, I do believe they do have some headlines left in them that they'll, any little tiny thing will be a massive headline, will be a gigantic thing. Any new customer they add, no matter how small it's going to be, is going to be a massive headline. It's not going to be false, but it's not going to be all that. So before I go, let me throw in a couple of disclaimers here, and I'll give you a target price on what I think Beyond Meat is probably worth today in looking at it realistically. The conclusions that I'm getting to about the framing effect are just my opinion. It's just consistent with everything that I'm looking at and all the decisions that were made along the way. And where they speak up and speak up loudly, and where they're silent and how they present things really looks like a framing effect. And I think it looks like a framing effect intended for the type of shareholder that they have. When I say that it looks like a pump and dump, that's my opinion, based on what I've seen, the framing of all the good stuff, the silence on anything that could question that good stuff, and the insider selling into this looks like a pump and dump, in my opinion. So for all you lawyers out there getting ready to do something, I'm not stating a fact. I'm stating an opinion. It is my opinion. It looks like this. I'm not attributing any intent to anybody or accusing anybody of doing anything. I'm just saying, in my humble opinion. Lawyers hate that word, in my opinion. In my opinion, it looks like that. Target price on Beyond Meat, $15, $20, I think is a right price for this company, given what I believe is negative growth year over year per customer, given what I believe is a limited ability to increase sales by adding new customers, because everyone's doing that. At some point, you're all going to bump into each other. That's just going to happen. Given the fact that you can replace meat as long as you're willing to accept a highly processed patty. I don't think it's going to take long for people to say, well, I can't get a New York strip, I can't get a lamb shank, I can't get prime rib, I can't get a turkey, I can't get a honey glazed ham, I can't get any of this stuff. All I can get is a patty, and I got to pay triple for it. So yeah, I think $15, $20 today would probably be about the right price on this. Certainly not $150. So yeah, I think 90% down is about right. I think over the years, as the fundamentals start to take hold and the momentum crowd starts to disappear, I think you'll see this thing drift down. In about 3 or 4 years, they may grow into a $25 to $30 price on their company. I don't know that they'll be profitable at that point in time. I think their profitability right now comes from a dislocation in the meat market because of the pandemic, and I think that they're going to be doing some major discounting. They've already announced that with Walmart, that they're going to be selling a product, 10 burgers for $16, and their cost, that's $1.60 per burger, is, when you look at the costs along with shipping, is at or just slightly below their costs. And I think they're doing this to really gain market share and market exposure while this dislocation is going on. I don't expect that to continue on. I don't see that this is a viable product to justify what, $8.5 billion market valuation. I think this is again $15 to $20 stock today.